We talked a little bit before about affordability. I do want to dig into that a bit more because according to Realty Hop's affordability index, housing affordability is so dismal that in 42% of the cities on the index, an average American is going to need to devote at least 40% of their income to own a home. And that's why I love talking a little bit about these side empires and really how to crank up your cash flow. I mean, this channel is all about cash flow, folks, and the only way to increase cash flow is to make more and spend less. I personally am not somebody that likes to skimp when it comes to lifestyle. I personally don't want the beans and rice model that Dave Ramsey talks about. It's never been appealing to me and never will be appealing to me. And frankly, the people that reach out that I have communications with from here on this channel, they don't want it either. It's not the type of goal setting that we do. We're more abundance minded versus scarcity minded. So I'm going to find a way to make more money before I'm going to find a way to cut into my lifestyle spending. When it comes into reducing costs, I definitely want to continue to find a way to pay as little in interest as I possibly can. That means I'm going to follow the other techniques on this channel to do that. I'm going to find a way to pay as little in taxes as I possibly can. I'm going to find a way to pay as little in things like insurance or other unnecessary expenses as possible, but it's not going to be the lifestyle portion. But it does, things are really bad. I want to kind of talk about a couple of these areas. Places like Miami, Los Angeles, New York, where an average family looking to buy a home is going to need to dedicate over 80% of their annual income towards housing. It's unsustainable, totally unsustainable. And traditionally, Americans have really been advised to spend no more than 30% of their income on housing costs. This is where your debt to income ratio comes in. But things like debt to income ratio only factor what's showing up on your credit report. It's imported into the 1003. And essentially, there are a lot of expenses that aren't included inside that. Things like my HOA, for example, and the property I'm sitting in right now, my HOA costs $670 by itself. That doesn't show up against my debt to income ratio. So when you add in all the housing expenses, it really does easily crank up well above what a lender would tolerate to get you an approval. The figure was really popularized by the US government back in 1981. And it's really been widely accepted as sort of the norm ever since. And I think that's pretty interesting that it's been going on for this many decades, 4 decades now. Really anyone who's familiar with this channel is going to know that we really do take intelligence allocation of one's finances really seriously. And I've just got to say how disastrous it will be for folks to be putting such a high percentage of their income into their housing. So if you're looking at something for yourself personally and it's not truly an asset, again, this condominium I'm sitting in right now that I purchased in December for about $640,000 is now worth somewhere close to $800,000, if you can believe that, in just an 8 or 9 month period of time. Now I've done a little bit of work to it, but not enough to justify that type of price increase. I'm already looking at selling simply because even with a 20% down payment, the cost on this property with the HOA as high as it is comes out to almost $4,200 with utilities and so forth. It's even a little bit more than that. So looking at this as a primary or as a secondary property that I don't rent and don't make any money from, it's just very, very difficult for me to justify putting that type of money in when I want to do the traveling that I'm doing and I spend so much time in Colorado. So I'm personally in this position as well where I'm reconsidering how much I really want to commit to something for personal use versus something that can actually generate revenue as an asset. And that's going to be extremely important for you guys to differentiate how you want to be spending your hard-earned money right now. Make sure you're investing your money into assets like short-term net cash flow solutions, such as pink houses as a great way of making money, or long-term net worth investments, things like stocks, traditional retirement accounts, cryptocurrencies, and real estate investments. But certainly we want to find a way to offset that outflow of money in order to maintain the highest level of cash flow possible. And that really boils down to earning. But 40% is not good, guys. 80% is obviously downright insanity. This insanity with affordability is really driving a lot of families right now and individuals to decide whether it's even worth it or can they afford to stay where they are today. And I'm looking at potentially trying to take this $640,000 condo, sell it for $800,000 and potentially buy something as a single family in a less desirable area because I'm right on the beach. Maybe I can go a bit inland here in the Tampa area and buy something for $400,000 or $500,000 and carve off about a $300,000 cost to myself along with the HOA fees. But I just want to really quickly share 12 least affordable housing markets in the U.S. I think this is pretty interesting. I wanted to put this list together for today's conversation. The list also is going to maybe give some investors an idea as to where they may or may not be able to invest their money, or maybe invest less or more, depending on that specific market, and whether that market could use a correction in the next 6 to say 24 months might be a great way to anticipate timing of their market as well. So coming in at number 12 is Boston, Massachusetts. It's got a median household income of $79,797. Median home price is $775,000, absolutely outrageous. And the housing share of income coming into 59.38%. Number 11 is Oakland, California, where homeowners will need to spend 60.85% of their income on housing. Number 10 is Santa Ana, California. That's a 62.14% of income going to housing. 9 is Anaheim, California, where 63.98% is going towards housing. Wouldn't you know it, another California city, San Diego, coming in at number 8, 65.65%. 7 is San Francisco with a median household income of $126,000, a median home price of $1.4 million, and 66.56% of income being forced to go towards housing. Number 6, guess where? That's right, California, folks. Long Beach, 69.77% of income going towards housing. And now we are here back on the east side, southeast anyway, in Hialeah, Florida. This is 72.55% of income going towards housing. Goodness gracious, how does anybody afford to live? Number 4 is Newark, New Jersey, 77.5% of income going towards housing. That's tough with gas prices and food costs the way they are today. Number 3 is New York. New York, median household income is $68.1 $1,000 annually and a median home price of $925K. 82.47% of income would be required to go into housing. 82.47%. We've got Los Angeles coming in at number 2, 85.34%. And number 1 least affordable city in the entire United States is Miami, Florida. Median household income is just $44,581 and a median home price of $610K, with a whopping 87.39% of income going towards housing. Michael, these places tend to be very hot markets, which is why their prices are sky high. But obviously, with residents needing to allocate over 60% of their income to their cost of housing, are these markets worth pursuing at this point for investors? And along with that, what kind of markets are you seeing the most potential in both short-term and long-term perspectives?
Yeah, I mean, no surprises on this list, and you were pointing them out. I mean, everything is going to be either right on the coast or close to the east or west coast. Obviously, was it Lanai or Hawaii that was in there? For obvious reasons, that's going to be expensive as well. So it's important to remember, we did a video on this recently as well. So you can look at these just astronomical housing prices there, but also know that if the market does kind of take a little bit of this dip, which we're kind of waiting to see what happens there, those coastal cities are going to be the ones that get hit the hardest, and they're going to get hit the first. So as an investor, I'm keeping an eye on those. Typically, I like to invest, if I'm coming in with cash, I like to invest in middle Americana. I like just, kind of the Midwestern states. I like to keep my cost basis low. If I'm an investor, I would rather, take $1 million and have, 5 to 8 houses as opposed to $1 million house, obviously, kind of spread the risk around as well and not have all my eggs in one basket. So, markets I love are like, Ohio, Tennessee, I love Missouri, Wisconsin, Minnesota. Now, all those states all have some big cities in them. I tend to really gravitate more towards those rural areas. And just to kind of dovetail off that, like Pink, for example, we've got a new cash buying lead generation source that we've just rolled out within the last handful of months, which is really just it's a conveyor belt of these deals that are affiliates that want to have participation with, small kind of cap rates, and, 50 to 100,000 $100,000 investments, for example, some fractional investing, they're going to have access to look at those deals as well that have really, really healthy returns on them, which is important because most people just don't know where to find the right deals that have the right meat on the bones that are in those right markets. So Pink actually does provide that. But as a personal investor, I really like those kind of middle of the country states as opposed to the coastals. That being said, I don't discount any market. There's money to be made in every single market. I can guarantee you I could get dropped off in any of those and have a deal together inside of days, period. You just have to know where to look, how to identify those deals, ultimately how to break them down. And there's nuances involved with that, but none of those markets would scare me. My approach would be different. My exit strategy would certainly be different. My allocation of capital obviously would be much greater in those, but at the end of the day, if the deals pencil out, if there's money to be made, and just I'm a math guy, if the math works, I don't care if it's in Timbuktu or San Francisco or Irvine, California.
I saw, it's interesting. You brought up a couple points I'd love to kind of counter if you don't mind. You talked a little bit about putting all your eggs in one basket versus diversification. You talked about spreading things out. If you had $1 million, maybe buying 4 or 5 $250,000 homes versus buying a one or two $500,000 to $1 million property there. And it's interesting because I actually saw a post from our friend Patrick Bet-David recently quoting, I want to say it was Carnegie, and he said, "Put all your eggs in one basket and then just watch the basket." Right. And I guess I had this exact conversation with a coaching member today. It's funny it's coming up again because he said the same thing. He said he's talking to his long-term investor buddy who's believing the exact same philosophy as you. I said, let's play the devil's advocate here, play skeptic. I don't necessarily disagree, but are we talking about a diversification geographically? Is it because we're worried about one area being targeted over another when it comes to a possible decline of values? Is it because we're talking about if this one property sits vacant for for a few months, then it's a much bigger hit than if we have a handful of properties and only one of those is vacant. But I also wanted to at least just acknowledge that this is not as easy as saying it's black and white, always better to have more of less expensive versus one of more. If we had, for instance, 2 or 3 $350,000, $500,000 properties that were being short-term rented, and we were able to get an average nightly rate that was significantly higher than a handful of twice as many half-price properties, then it would seem to me that it would be better to take the more expensive property because it's going to take twice as much work. I do the same amount of work on one $500,000 property that somebody else does on one $200,000 property, and I may command $400 a night and they may command $75 a night. I think comparing side by side in that case makes a lot of sense. I also think that you have twice as many potential issues. You've got twice as many furnaces, roofs, toilets, and let's face it, tenants or guests, which means that the only issues I've ever had with landlording, Michael, have come from maintenance and tenants or guests. So I know that if I have twice as many of those things to worry about, I'll have twice as many issues. It's the same $1 million either way. I guess I just wasn't necessarily convinced that buying more of less expensive was better than buying fewer of more expensive. So I guess it would probably depend case by case in that situation. Furthermore, and just one last point, is you're talking about the coastlines, and we're obviously seeing that these are just scorching red hot markets, have been now for quite some time. And that's because they are desirable areas that oftentimes tend to pull the higher price tags when it comes to rental income and or short-term nightly rates. These are desirable areas that people like to visit. So if I'm buying a short-term rental, I realistically going to have to expect that I'm going to do better somewhere at the beach than somewhere in the middle of Nebraska. It just tends to work out that way. So I just wanted to those were ideas that had come to mind when you were chatting. I'm just curious if you had any reaction to that.
Yeah, no, that's spot on. And I probably should just clarify that a little bit better. If I'm looking at a long-term rental, for example, I'm going to be looking at it through that lens. If you're talking about short-term rentals, yeah, it's going to be, I'd rather have one monster $1 million house in Orlando, which is a market we love for short-term rentals, than obviously 10 $100,000 houses spread out across the country. Also, management, which should come into play. I mean, if you are looking at buying multiple long-term rentals, look at management. Take that headache off your plate. Short-term rentals, same thing. Look at management. Obviously, we've talked about Lavish Keys on here doing that white glove management services, but it's definitely going to be depending on the investment class, short-term versus long-term rentals, really what that exit strategy is going to look like. And that's going to really guide how I deploy capital. So I should have been a little bit more clear on that. We see that the exact same way, though. I would rather have one monster $1 million house than 10 $100,000 houses every single day of the week and twice on Sunday in that short-term rental space.
Fair enough. Fair enough. And that's kind of what I anticipated. Just wanted to make sure that people understood it makes sense to take the time to really lay these opportunities in front of you and try to make as close to comparisons as you're able. Even though you may be discussing apples and oranges, we're still probably discussing fruit. So I think it's important to make sure that we're analyzing these opportunities correctly in the months and years to come. But ultimately, again, I think it just really boils down to cash flow, making sure that you're looking for ways of really increasing your earnings potential while simultaneously constantly auditing the liability side of that balance sheet and making sure that you don't have any unnecessary leaks, taking that a step further and making sure that you're manipulating the way that your debts are being serviced, taking it a step further and then making sure that, of course, you're accelerating the way that your debts are being accelerated. You can pay those off in a fraction of the time, especially the non-mortgage related high interest type of consumer debts. And finally, of course, then applying any additional investing liquidity that you may have into opportunities that can have huge payoffs. Like I said, I've been successfully blessed enough to do that in a variety of different industries that have really allowed me to live whatever lifestyle I want, including 6 months of full-time RVing last year, including really 3 out of the last 4 months being able to take time away with my family during a tragic loss, and recently just being able to go to Colombia and do some networking and some business down there during a wedding event that I was invited to. So it's been truly a lifesaver for me, and I can't stress enough to people who are listening that you have that same opportunity in front of you. I'm no different than you. Michael's no different than you. We had to start somewhere. When we started, we were scared. When we started, we were overworked. And over time, with consistency, that effort began to pay off. And we were ultimately able to really streamline a lot of our processes and systems, and in order to really automate the way that money comes to us, to where price tags, whether we're being generous or whether we're being selfish, are no longer much of a factor at all. So that's really, I think the net outcome here is freedom of choice, how you're going to spend your time, how you choose to spend your money. And so you can live life on your terms, folks. These are cliche sayings for a reason. One last time on that email address, pink@vipfinancialeducation.com is where you'll reach out, put your first name, last name, and make sure you put your contact phone number in there. Be sure to check out the videos in the description. Those are going to answer a lot of your questions regarding what Michael was talking about here related to that business model. If you're still looking for a side hustle or side empire where you can really dominate spending that 15, 20 plus hours each week on something that's your own, where you can make hundreds of thousands, and there is a plethora, a collection of different ways of making money in there inside real estate during the toughest times, and really where we see things heading now, where things are going to continue to get a little bit trickier and more volatile over the next 6 to 24 months. Little Pink Houses of America is really going to be an option you're going to want to take a strong look at. With that in mind, hey, Michael, I do appreciate all your insight once again on this. Always an interesting topic. We'll be sure to come back and hit you guys with updates as they're happening, because I'm sure there will be plenty just through this year alone, much less in the coming years. So stay tuned to the channel. Make sure you're a subscriber if you're not one already. And also be sure to drop a thumbs up for us, please, if you don't mind. It helps us so much with the algorithm. And until we see you on the next one, Michael, again, thank you so much. And guys, make it a great day and keep on cash flowing. See you soon.